Hello and welcome to Module 4 of Pepperstone's Intermediate Trading course, Trading Indicators. In this section, we will look at the different types of moving averages available to traders, and which of these popular indicators work best together to help identify trend direction, trend change, and how they can provide dynamic support and resistance. In this lesson, you will learn how to understand the differences between the moving averages, how to determine the trend direction using moving averages, how to use moving averages for dynamic support, and how to use moving averages for dynamic resistance. Moving averages are an extremely popular indicator that are widely used by traders to help determine the direction of the trend. As the name suggests, a moving average is an average of the price action that has happened for a set period. Because moving averages are based on an average of the price action, they do a great job in smoothing out the market and reducing the noise, in turn giving traders a clearer view of what has happened. There are two common types of moving averages available on most platforms, and they are the simple moving average, or SMA, and the exponential moving average, which is commonly referred to as an EMA. The simple moving average is the direct average of the period that is being calculated. For example, a 10-period moving average is the average movement for the last 10 periods. An exponential moving average is calculated to give greater weight to the most recent prices. In the case of the 10-period exponential moving average, more weight is given to the current and most recent prices than the prices of 8, 9, and 10 periods ago. The actual formula for an exponential moving average is a little more complex, but realistically, knowing how it is calculated is not necessary if you understand what it represents, as the trading platform will calculate it for you. It is important to understand that an exponential moving average will have less lag than a simple moving average, because more weight is given to the most recent values, which makes the EMA a faster moving average than the SMA. The example that we see on the screen displays what a 20-period simple moving average looks like on a chart marked in red, and what the same 20 periods look like when they are represented by an exponential moving average marked in blue. Notice how the exponential moving average reacts quicker to the price action, and leads the slower moving average every time price moves quickly, even though they both represent 20 periods. The chart that we can see on the screen does not provide any information about what time frame it represents, so you don't know how long each period is. This has been done deliberately to highlight an important point. When you place any moving average on a chart, it will always adapt itself to the time frame that you are on. For example, if you are on a daily chart with a 20-period moving average on it, and then you change that chart to a 4-hour time frame, the moving average will automatically readjust itself, so it will represent the last 20 periods on the 4-hour chart, not the last 20 daily periods. The chart that we can now see on the screen is going to demonstrate what 3 simple moving averages look like when they are placed on it. Although we don't know what time frame this chart represents, we do know that the moving averages represent the candles on that chart, so the 10 SMA represents the last 10 candles on this chart, and the 20 SMA represents the last 20 candles on this chart. You can see that the slowest of the moving averages, the 50 period, marked in green, is the slowest to react compared to the 20 period and the 10 period moving averages that stay a lot closer to the price action. Moving averages are a great way to determine the direction of the current trend, and it is easily worked out using 2 simple conditions. Condition 1. When price is below the moving average, the market is in a downtrend. And condition 2. When price is above the moving average, the market is in an uptrend. You can see on the chart on the screen that the period marked between the horizontal arrows where price was in a downtrend, as all of the price action was below the moving average. On the right of the chart where price crossed above the moving average, you can determine that this period between the horizontal arrows represents a time when price was in an uptrend, as price traded above the moving average. You can confirm when a change of trend occurs by simply waiting for price to cross over and trade above or below the moving average. As we can see on the chart on the screen, the price has traded below the moving average and then moved up above it, confirming that the trend has changed from a downtrend to an uptrend. Over at the top of the chart, price came down and touched the moving average. If price crosses below and remains there, this will confirm a change of trend from an uptrend to a downtrend using this one moving average method. At this point, you may be wondering what period of moving average I am using and why I chose it. When I talk about different periods of moving averages, I like to stick to the numbers that are the most popular amongst traders. I use the 10 and 20 period moving averages to determine the speed of the trend, and the 50 and 200 period moving averages for the direction of the trend. The 200 moving average is the optimal moving average for long-term trends because it is one of the most recognized around the world. Plus, the current position is using the last 200 periods of time to plot its level, making it fairly reliable. Before the abundance of different trading opportunities we have today were available, most of the world traded the stock market and commodities using daily charts. So a 10-period moving average would represent 2 weeks, and a 20-period moving average would represent a month of trading. These moving averages became commonplace and have remained so today, so I choose to work with them, as they provide a balanced view of what the market is doing in any time frame. It is important to remember that the more traders that see what you are seeing, the more chance there is of what you are expecting to happen will eventuate. If you choose to trade in a long direction, if price crosses a 35 moving average, and you're the only one that sees it, then your chances of being correct may be reduced. Another way to determine the direction of the trend is by using two moving averages and comparing them to each other. Similar to how price was used with one moving average, with this method, you are looking for two conditions. Condition 1. If the fast moving average is above the slow moving average, then the market is in an uptrend. And condition 2. If the fast moving average is below the slow moving average, the market is in a downtrend. You can see the chart on the screen, the period marked between the horizontal arrows where price was in a downtrend, as the fast moving average is below the slow moving average. On the right of the chart, where the fast moving average crossed above the slow moving average, you can determine that this period between the horizontal arrows represented a time when price was in an uptrend. The chart that we can see on the screen shows what a change of trend looks like using this method. You need to be on the lookout for a cross of the fast moving average from below to above the slow moving average for a change to an uptrend, and a cross of the fast moving average from above to below the slow moving average to change to a downtrend. For moving average crossover trend confirmations, I choose to use exponential moving averages. Because these moving averages are faster and more dynamic than a simple moving average, they can provide a confirmation of trend change faster. As this method uses two indicators as confirmation, the breakouts and false signals generally associated with faster moving averages are significantly reduced, making them a nicely balanced choice. As well as helping to determine the direction of the change of current trends, moving averages are a fantastic tool to use as dynamic support. Unlike static horizontal support levels, moving averages are classified as dynamic support because they are constantly adjusting to what the price action is actually doing. As we can see in this example, throughout this uptrend, price pulled back down to the moving average and rejected off it to continue into the trend's original direction. Moving averages can also act as dynamic resistance in a downtrend. Again, unlike static horizontal resistance levels, moving averages are classified as dynamic resistance because they are constantly adjusting to what the current market is doing, as price makes lower highs and lower lows. The example that we see on the screen now shows that throughout this downtrend, price came back and touched the moving average and then rejected off it, only to continue in the original trend direction. The 50-period moving average is considered a very strong provider of dynamic support and resistance, and when it comes to choosing the right numbers, the only moving averages I consider for support and resistance are the 50-period and the 200-period moving averages. I also choose to only use simple moving averages for support and resistance, due to the consistent smoothing they provide over longer periods. In this lesson, we learned how to understand the differences between moving averages. how to determine trend direction using moving averages, how to use moving averages for dynamic support, and finally, how to use moving averages for dynamic resistance. This concludes section 1 of trading indicators. In the next lesson, we will be looking at moving average convergence divergence, more commonly known as MACD. This powerful indicator is widely used, but not many traders understand how and why it actually works. Hello and welcome back to Module 4 of Pepperstone's Intermediate Trading course, Trading Indicators. In this section, I will explain how to interpret and use the very popular moving average convergence divergence indicator. We will look at the different ways that you can use this powerful indicator, as well as identifying the market conditions that it works best in. In this lesson, you will learn what the MACD indicator represents and how it forms, how to interpret the MACD indicator, how to trade the MACD indicator crossovers, and how to interpret and trade the MACD divergence. The MACD indicator, which is an acronym for Moving Average Convergence Divergence, is one of the most powerful indicators available to traders. It is one of the rare indicators that works well in directionless markets, as well as trending markets, and is often referred to as a trend-following momentum indicator. The primary purpose of MACD is to show the relationship between two moving averages, and is calculated by subtracting the larger moving average from the smaller moving average. The general settings on nearly all trading platforms is a 26-period EMA, a 12-period EMA, with a 9-period SMA of the MACD line called the signal line, plotting on top of the MACD histogram. Let's now take a look at how the MACD indicator generates its signals. The difference between the 26 and the 12 EMAs is represented on a histogram below the chart, and gives traders very important information about how the moving averages are reacting to price movements and each other. You can see in the example on the screen that the 12 and the 26 EMAs are on the chart like a normal moving average would appear, but in the window below the chart, the histogram in blue measures the distance between the two. When the fast EMA is above the slow EMA, the histogram is above the zero level, and when the fast EMA crosses below the slow EMA, the histogram switches to below the zero level. As we can see on the screen, every time there is a cross of the 12 and the 26 EMAs, the histogram switches from above to below or below to above the zero line, highlighted by the vertical dotted lines. The first trading strategy we will look at is the MACD crossover. When looking for trades with this method, you need to be on the lookout for instances where the histogram is below the zero level and rises from below to above the signal line, as you can see highlighted with the yellow circles on the chart. A long order can be placed as this signal line exits the histogram. When looking for short trades using this method, the opposite is true, and you need to be on the lookout for instances when the histogram is above the zero level and falls from above to below the signal line, as you can see highlighted in the red circles on the screen. As the signal line exits the MACD histogram, a short order can be placed. Although this appears to be a very simple method, it can be very effective in getting you into the market at great levels before moving up or down, and works well in directionless and trending markets. The next strategy that we will look at is divergence. Now, divergence is a commonly used concept when it comes to trading, and there wouldn't be many seasoned traders around who haven't traded using a divergence signal at some stage. Identifying divergence as it is happening is key to being able to trade it successfully, but understanding why it is forming and where it is located on the chart is the most important aspect. Divergence appears on a chart when the price action and the oscillator-based indicators move in opposite directions. In a normal healthy market, when price makes a new high, the indicator is also expected to make a new high. If the movement of the price and indicators aren't moving in a synchronized manner, then divergence is generally present. There are two types of divergence: bullish divergence, which is generally found in a downtrend, indicating a potential market move long, and bearish divergence, which is usually found in an uptrend, indicating a potential market move short. There are also three different classes of divergence, with the first type, Class A, illustrated on the screen. Class A bullish divergence occurs when price makes a lower trough and the indicator makes a higher trough. Remember that in a healthy market, the indicator would have also made a lower trough at the same time price did. Class A bearish divergence occurs when price makes a higher peak and the indicator fails to follow, making a lower peak in the same area, as you can see in the example. The chart that we can see on the screen now displays a real example of Class A bullish divergence in action. There is a downtrend in motion with a series of lower highs and lower lows. The MACD indicator is following the price action down and consistently getting lower as price does. When price reached the new lower trough, the MACD indicator failed to make a new low, highlighted by the two sloping lines. This is a clear case of Class A bullish divergence, and price would be expected to react to this divergence and move in a long direction from around this point. Let's now take a look at a real example of Class A bearish divergence in action. On the chart on the screen, there is an uptrend in place, with a series of higher highs and higher lows. The MACD is following the price action up, and consistently getting higher as price does. When price reached a new higher peak, the MACD indicator failed to make a new high, highlighted by the two sloping lines. Again, this is a clear case of bearish Class A divergence, and price would be expected to react to this divergence and move in a short direction from around this point. The second type of divergence is Class B divergence, as we can see here on the screen. Class B bullish divergence occurs when price makes an equal trough, and the indicator makes a higher low. In a healthy market trend, the indicator would have also made an equal trough at the same time price did. Class B bearish divergence occurs when price makes an equal peak and the indicator fails to follow, making a lower peak in the same area. The chart that we can see here on the screen displays a real example of Class B bullish divergence in action. There is a downtrend in motion with a series of lower highs and lower lows. The MACD indicator is following the price action down and consistently getting lower as price does. When price made an equal trough, the MACD indicator failed to make a new low, highlighted by the two dotted lines. Let's now take a look at a real example of Class B bearish divergence in action. As you can see on the chart on the screen, there is an uptrend in place, with a series of higher highs and higher lows. The MACD indicator is following the price action up, and consistently getting higher as price does. When price made an equal peak, the MACD indicator failed to make a new high, highlighted by the two dotted lines. The final type of divergence is Class C divergence, as we can see with the examples on the screen. Class C bullish divergence occurs when price makes a lower trough and the indicator makes an equal trough. In a healthy market trend, the indicator would have also made a lower trough at the same time price did. Class C bearish divergence occurs when price makes a higher peak and the indicator fails to follow, making an equal peak in the same area. The chart that we can see on the screen now displays a real example of Class C bullish divergence in action. There is a downtrend in motion with a series of lower highs and lower lows. The MACD indicator is following the price action down and consistently getting lower as price does. When price made a lower trough, the MACD indicator failed to make a new low, highlighted by the two dotted lines. Finally, let's look at a real example of Class C bearish divergence in action. There is an uptrend in place with a series of higher highs and higher lows. The MACD indicator is following the price action up and consistently getting higher as price does. When price made a higher peak, the MACD indicator failed to make a new high, highlighted by the two dotted lines. So which class of divergence is better? Divergence plays a big role in my trading, especially the MACD form of divergence. I personally only use Class A and Class B divergence, as I don't believe that the Class C form is as reliable or as explosive. The most important thing about the MACD divergence is understanding what the indicator is trying to tell you. In the case of Class A and Class B bullish divergence, the histogram is representing the difference between the 12 EMA and the 26 EMA. If the histogram trough fails to make a new low when price does, it is a sign that the 12 EMA is not moving as fast as it was at the previous low. In fact, it has slowed to the point where it is getting closer to the slower 26 EMA. When a moving average begins to slow down and gets closer to price in a downtrend, the trend is losing momentum, and although price has pushed down to a lower point than the previous low, it has done so with less power, and that is what the divergence is indicating. In this lesson, we have learnt what the MACD indicator represents and how it forms. We have learned how to interpret the MACD indicator. We have learned how to trade MACD crossovers. And we have learned how to interpret and trade MACD divergence. This concludes section 2 of trading indicators. In the next section, we will examine the popular stochastic indicator. This powerful indicator is also widely used, and I will show you the best ways to interpret its signals and explain the type of market it works best in. Hello and welcome to Module 4 of Pepperstone's Intermediate Trading course, Trading Indicators. In this section, we will look at how to use and interpret the stochastic oscillator. We will look at the different ways that you can use this powerful indicator, as well as identifying the market conditions that this popular indicator works best in. In this lesson, you will learn how to trade the simple stochastic method, how to trade the stochastic crossover method, how to trade the stochastic trending method, and how to interpret and trade stochastic divergence. The stochastic oscillator is a momentum indicator that compares the closing price of a trading instrument to the high and the low range of its price over a defined number of periods, which is generally 14. The oscillator adjusts itself with the same settings to any time frame, and works well with most trading instruments as long as the market conditions are correct. The stochastic oscillator is designed to follow the speed or momentum of price, which is generally changing before price itself does. As with many of the high-profile indicators, many traders interpret their signals incorrectly, or use them in the wrong type of market. Because the stochastic is an oscillator, which basically means it is bound within a range, its most effective use is in a range-bound or directionless market. But I will show you how you can use this powerful indicator in trending markets effectively. Let's first take a look at how the stochastic oscillator is calculated. The stochastic oscillator is made up of two lines, a %D line, which is the slow line, and a %K line, which is the fast line. The formula to calculate the %K line is 100 multiplied by the most current price minus the lowest price of the last 14 periods. This value is then divided by the highest price of the last 14 periods minus the lowest price of the last 14 periods. The %D line is a simple 3-period moving average of the %K line. As I mentioned earlier, the stochastic oscillator is range-bound between 0 and 100, so when the stochastic lines go below 20, the market is considered oversold, and when the stochastic lines go over 80, the market is considered overbought, highlighted in the example we can see on the screen. There are a few different ways that you can trade the stochastic oscillator, and generally the method you should use depends on what type of market you are in. Let's first take a look at the simple trading method. The most common and simple way to trade stochastic is in a range-bound or directionless market. You prepare your charts by drawing the 80 zone and marking it overbought, and then drawing your 20 zone and marking it oversold, as we can see here in the example. For a sell condition, you wait for the fast %K line to enter the overbought zone, and when it exits this zone, you can enter a short position on the open of the next candle or bar. It is important to remember to wait for the candle or bar to close before placing a trade, as often the signal line looks like it is above the overbought level during the candle, but fails to finish above it on the close. You can take profit on this trade when the %K line crosses below the oversold line. For a buy condition, the opposite is true, and you wait for the fast %K line to enter the oversold area, and when it exits this zone, you can go long on the open of the next bar or candle. You can take profit on this trade when the %K line crosses above the overbought line. Now this is the most simple way to trade the stochastic oscillator, but it is very important to remember that this method will only work when the market you are trading is moving sideways and not trending. Let's now take a look at the crossover trading method. A more effective method for trading the stochastic is similar in style to the one we just worked through, only this time the signal line crossovers are used as confirmation. You prepare your charts in the same way as a simple method, by drawing the 80 zone and marking it overbought, and then drawing the 20 zone and marking it oversold. Using the crossover method, a sell condition is generated when the %K line crosses into the overbought zone and whilst up there, crosses from above to below the %D line. It is important that the cross actually happens inside the overbought zone. If it happens after the lines have crossed back through, it is not a valid signal for this method. A take profit for this trade is triggered when the %K line crosses from below the %D line to above it. The vertical red lines that we can see on the chart highlight all of the crosses that gave valid sell signals. Notice that all of the crosses occurred inside the overbought zone. A long condition is set up the same way. When the %K line crosses from below the %D line to above it, and both lines are in the oversold area, you can place an order to go long. The same rule applies, that if the cross happens when the lines have already crossed above the 20 level, the signal to go long is not valid. A take profit for this trade is triggered when the %K line crosses from above the %D line to below it. The vertical green lines on the chart highlight all of the valid crosses to go long. Again, you will notice that all of these crosses occurred inside the oversold zone. This method of trading works very well in sideways markets, and depending on what time frame you are on, you can trade using these signals for many hours, and in some cases on larger time frames, many weeks. As it was with the simple method, the crossover strategy only works well in directionless markets, and should not be traded if there is a trend present on the chart that the stochastic oscillator is located on. Now let's take a look at how you can use the stochastic oscillator in a trending market. Now, although this indicator generally works well and is traditionally traded in directionless markets, there is a method that you can use to trade in the direction of the trend. Let's first look at the stochastic oscillator in an uptrend. Firstly, we need to establish that the market is in an uptrend, so we will be on the lookout for a series of higher peaks and higher troughs. When there is a strong uptrend in place, the stochastic oscillator rarely moves deep into oversold zones, so we need to raise the oversold zone from 20 to 30, as we can see here in the example. When the %K line goes below the new oversold zone of 30 and crosses from below the %D line to above it, you can take a long position on the open of the next bar or candle. For this method, it isn't necessary for the cross to happen inside the oversold zone, as you are attempting to trade in the direction of the trend, and a cross above the zone only helps signal the strength of the uptrend. However, it is important that both lines moved into the oversold zone before the cross to validate the trend's pullback. There is no set take profit level associated with the trending method, as you are joining an existing trend, and you should be on the lookout for more compelling take profit zones, such as areas of resistance above price. What you should never do in an uptrend is attempt to enter a short position when price moves into the overbought zone. When a market is trending up, stochastic can remain in an overbought zone for extended periods of time, and provides no assistance in helping determine when a trend may end. Notice on the chart that the overbought zone has not been placed on the oscillator. Now let's take a look at the stochastic oscillator when it is used in a downtrending market. Firstly, we need to establish that the market is in a downtrend, so we will be on the lookout for a series of lower peaks and lower troughs. As it was with a strong uptrend, when there is a strong downtrend in place, the stochastic oscillator rarely moves deep into overbought zones, so we will need to lower the overbought zone from 80 to 70. When the %K line goes above the new overbought level of 70 and crosses from above the %D line to below it, a short position can be placed on the open of the next bar or candle. Again, it isn't necessary for the cross to happen inside the overbought zone, as you are attempting to trade in the direction of the trend, and a cross below the zone only helps signal the strength of the downtrend. It is still important for both lines to move into the overbought zone prior to the cross to validate the trend's pullback. Once again, there is no set take profit level associated with this method, as you are joining an existing trend, and you should be on the lookout for more compelling take profit zones, such as an area of support below price. As it was with uptrends, what you should never do in a downtrend is attempt to enter a long position when price moves into an oversold zone. When a market is trending down, stochastic can remain in an oversold zone for extended periods of time, and provides no assistance in helping determine when a trend will end. You will notice on the chart that I haven't placed an oversold zone on the oscillator. The final method for trading using the stochastic oscillator is the divergence method, which is generally considered one of the most effective. You will remember earlier in this module we discussed the concept of divergence. Divergence occurs on the stochastic oscillator in much the same way it did with MACD, and you can apply the same rules on how to trade it. The example we see on the screen has a situation where price has made a higher high and the stochastic oscillator has failed to follow, only making an equal high at around the same area. You will recall that this is considered Class C bearish divergence. Over in the middle of the chart, price has made a new lower trough, and the stochastic oscillator has failed to follow, making a higher low at around the same area. This can be labelled Class A bullish divergence. Finally, on the right of the chart, price has made a higher peak, and the stochastic oscillator has failed to follow, making a lower peak at around the same area. This can be labelled Class A bearish divergence. The key to using the best divergence signals on the stochastic oscillator is only trading the divergence where the first peak is in the overbought zone for bearish divergence, or the first trough is in the oversold zone for bullish divergence. Following this rule highlights the extremes that the stochastic oscillator has reached, which strengthens the case when divergence signals appear. I find that although divergence can work well in trending markets, it is at its most powerful with this indicator when it occurs in directionless or sideways markets. I find that the moves are more explosive in these types of markets because the weakness in momentum that the stochastic oscillator is displaying helps lead price with no opposing force, whereas in trending markets, the shift in momentum can sometimes conflict with the strength of the trend. Notice how on the example on the screen, the chart is in a sideways market with no clear trend, and you can see how the divergence occurred in the oversold and overbought zones, with price accelerating quickly once the divergence was evident. In this lesson, we have learned how to trade the simple stochastic method. We have learned how to trade the stochastic crossover method. We have learned how to trade stochastics in a trending market. And we have learned how to interpret and trade stochastic divergence. This concludes section 3 of Trading Indicators. In the next section, we will look at the Relative Strength Index. Not to be confused with other forms of relative strength, the RSI is a unique indicator which helps signal weakness and strength in market trends. Hello and welcome to Module 4 of Pepperstone's Intermediate Trading course, Trading Indicators. In this section, we will look at how to use and interpret the Relative Strength Index. More commonly known as RSI, we will look at the different ways that you can use this momentum indicator, as well as identifying the market conditions that the RSI works best in. In this lesson, you will learn how to establish a trend bias using RSI, how to trade the RSI in the direction of the trend, how to identify and trade RSI failure swings, and how to interpret and trade RSI divergence. The Relative Strength Index, more commonly known as the RSI indicator, is a momentum indicator that measures speed and change of price movements. Like the stochastic oscillator, the RSI indicator is also an oscillator and operates in a band between 0 and 100. Not to be confused with traditional relative strength, where one instrument is measured against another. The RSI measures the average gain over a set period versus the average loss over the same period on the same instrument. RSI is most commonly traded using overbought and oversold zones, but we will look at how you can interpret and use this powerful indicator in different market conditions. Let's first take a look at how RSI is calculated, which will help you understand how and why this indicator works best in different market conditions. The RSI indicator is made up of one line, the RSI level, which involves a two-step process to generate the value. The first step is to calculate the relative strength value. This is worked out by taking the average gain of positive periods for a set time frame and dividing it by the average loss of negative periods for a set time frame. Calculating the average gain is done by multiplying the previous average gain by 13 and adding that to the current average gain and dividing it by 14. The current average gain is the sum of gains over the prior 14 periods divided by 14. Calculating the average loss is done by multiplying the previous average loss by 13 and adding that to the current average loss and dividing it by 14. The current average loss is the sum of the losses over the prior 14 periods divided by 14. Now that we have worked out the RS value, the second part of the calculation can be worked out, which gives the RSI level. The calculation for the RSI level is 100 minus 100 divided by 1 plus the relative strength calculation. This formula normalizes the relative strength and turns it into a range-bound oscillator that fluctuates between 0 and 100, making it easier to recognize extreme levels. Although the calculation may seem a little complicated, the reality is that you will never have to work it out manually, as most platforms have the RSI indicator as standard, and it adapts itself to each time frame you put it on, using the last 14 periods to plot its level. However, understanding how the RSI is derived is important in the context of adapting it to the market that you are looking at. For example, the RSI at the 100 level tells you that price was higher for all of the prior 14 periods, and if the RSI level is at 0, there are no gains for the prior 14 periods, meaning price must have been lower for the entire time, as there are no gains to measure. Let's first take a look at using RSI to establish a trend bias. For this method, you first identify a trend. In this case, you can see on the screen that there is a downtrend in place, with a series of lower peaks and lower troughs. You can see that the RSI indicator remained under the 50 level for the entire time during the downtrending periods. To trade this method, you simply place a trade in the direction of the trend each time the RSI rises from its lows and comes up to touch the 50 level. You can see at the beginning and in the middle of the chart that a downtrend is in place, and each time the RSI came up and touched the 50 level, it gave another opportunity to join in the downtrend. The opposite is true for an uptrend. When you identify an uptrend with a series of higher peaks and higher troughs, you simply place a trade in the trend direction each time the RSI line pulls back down from its highs and touches the 50 level. Although this method is sound, all the RSI is really doing is confirming what you probably already know, that the market is in an uptrend or a downtrend. It does, however, signal good pullback opportunities to join in the direction of the trend, as often the market pulls back right to the 50 level at the deepest point of its retracements. A more robust method of using the RSI in a trend is waiting for the RSI to cross the 50 level during a trend and then crossing back in the trend's direction. You can see on the chart on the screen that there is a series of lower peaks and lower troughs confirming a downtrend. The RSI then crosses above the 50 level, only to come back down not long after. A trade can be placed in the direction of the trend once the RSI closes below the 50 level. On the right of the chart, you can see that there is an uptrend in motion, with a series of higher peaks and higher troughs. Once the uptrend was confirmed, the RSI crossed below the 50 level, only to cross back up shortly after. A trade can be placed in the direction of the trend once the RSI closes above the 50 level. This method, although simple, is a reliable way to use the RSI indicator, as a cross of the 50 level in either direction, followed by a cross back in the direction of the trend, confirms that the buyers in an uptrend and the sellers in a downtrend have committed to the trend's direction over the last 14 periods. Let's now take a look at how you use the RSI indicator using overbought and oversold levels in trending markets. Similar to the stochastic oscillator, this method involves changing some of the settings on the levels to provide optimal retracement zones. Traditionally, the 30 level on the RSI indicator is considered an oversold level, but in a healthy uptrend, the market rarely pulls back to these levels, and if it does, it often signals that the strength of the trend could be questionable. To trade this method in an uptrend, you simply raise the oversold level from 30 to 40. Although this makes the oversold level larger, it gives the market an opportunity to pull back to a solid level without losing too much momentum. Once the chart has been adjusted, you will be on the lookout for an uptrend, with a series of higher peaks and higher troughs. Once the uptrend is confirmed, you wait for the RSI line to drop and close below the new oversold level of 40. When the RSI line crosses back above this level, you have a signal to take a long position in the direction of the trend. The two vertical lines on the chart we can see on the screen represents where this has happened, and although the entry points are only just crossing into the oversold zone, it helps illustrate why these levels need to be raised, as not to slow up too much upward momentum. Trading this method short again involves changing some of the settings on the levels to provide optimal retracement zones. Traditionally, the 70 level on an RSI indicator is considered an overbought level, but in a healthy downtrend, the market rarely pulls back to this level, and if it does, the strength of the trend is in serious doubt. To trade this method in a downtrend, you lower the overbought level from 70 to 60. Once again, even though this makes the overbought level larger, it gives the market an opportunity to pull back to a solid level without losing too much momentum. Once the chart is prepared, you will be on the lookout for a downtrend, with a series of lower peaks and lower troughs. Once a downtrend is confirmed, you wait for the RSI line to rise and close above the new overbought level of 60. When the RSI line crosses back below this level, you have a signal to take a short position in the direction of the trend. The two vertical lines on the chart we can see on the screen represent where this has happened, and once again, although the entry points are only just crossing into the overbought zone, it helps illustrate why these levels need to be lowered, as not to slow up too much downward momentum. I have deliberately used the same chart in the example for buying and selling opportunities to highlight how often these signals can occur. Now let's take a look at RSI failure swings. Failure swings are unique to RSI in that they are recognized as strong indicators of possible reversal signals, without factoring in price action. The actions of the signal line are the focus of failure swings, not price action, and often provide reliable signals when they form. I like to adjust the oversold and overbought levels to 40 and 60 respectively for this method to help maintain market momentum. A bearish failure swing forms when the RSI line moves above the overbought line and drops back through it, only to retreat to around the same level, before making a new low. You can see in the example on the screen, highlighted by the blue box, that prices sold off aggressively once this failure swing is confirmed. You can place a trade short on the open of the next bar or candle, once the failure swing has confirmed a new low. A bullish failure swing works in much the same manner, and forms when the RSI line crosses below the oversold level of 40, retraces back to close above the 40 level, only to come back again to test the 40 level. The RSI line then holds above this level and goes on to make a higher high, as highlighted in the example in the blue box. You can place a trade long on the open of the next candle once the failure swing has confirmed a new high. Finally, let's take a look at trading RSI divergence. Divergence occurs on the RSI indicator in much the same way that it does with the MACD and stochastic, and you can apply the same rules in how to trade it. The example we see on the screen displays a situation where price has made a lower low, and the RSI indicator has failed to follow, making a higher low at around the same area. You will recall that this is considered Class A bullish divergence. Over in the middle of the chart, you can see that price has made a new higher peak, and the RSI indicator has failed to follow, making a lower peak at around the same area. This can be labelled Class A bearish divergence. Finally, on the right of the chart, you can see that price has made a lower trough, and the RSI indicator has failed to follow, making an equal trough at around the same area. Similar to the stochastic oscillator, the key to using the best divergence signals on the RSI indicator is only trading the divergence where the first peak is in the overbought zone for a bearish divergence, or the first trough is in the oversold zone for bullish divergence. Applying this rule highlights the extremes that the RSI indicator has reached, which strengthens the case when divergence signals appear. In this lesson, we have learned how to establish a trend bias using RSI. We looked at how to trade RSI in the direction of the trend. We learned how to identify and trade RSI failure swings. And finally, we learned how to interpret and trade RSI divergence. This concludes section 4 of trading indicators. In the next section, I will explain how to interpret and use the Bollinger Bands indicator, one of the best market volatility indicators available to traders. Hello and welcome to Module 4 of Pepperstone's intermediate trading course, Trading Indicators. In this section, we will look at how to use and interpret Bollinger Bands. We will look at the different ways that you can use the Bollinger Bands indicator, as well as identifying the market conditions that it works best in. In this lesson, you will learn how to interpret the different Bollinger Band deviations, the rules for trading the Bollinger Bands indicator, how to use the Bollinger Bands indicator in extreme moves, and how to interpret and trade Bollinger Band divergence. The Bollinger Bands indicator is a volatility-based indicator that has bands above and below a moving average. The indicator is based on standard deviations, which expands and contracts as volatility increases and decreases. Bollinger Bands are a highly dynamic indicator, widening when volatility increases and narrowing when volatility reduces. This indicator can be used on any time frame, and the standard settings on most platforms is a 20-period simple moving average, with the bands on each side set at 2 standard deviations. Let's take a look at how Bollinger Bands are calculated for a standard platform setting. The middle band is generally set at a 20-period simple moving average. The upper band is a 20-period simple moving average plus the 20-period standard deviation of price multiplied by 2. The lower band is a 20-period simple moving average minus a 20-period standard deviation of price multiplied by 2. It is suggested that the 20-period moving average is the most useful for this indicator, and as I have mentioned in earlier modules, it is ideal to be trading what everybody else is seeing, so I recommend keeping this setting consistent. Let's now take a look at an example of what the Bollinger Bands indicator looks like on a chart, and see how the bands interact with price. You can see on the screen that the middle band is a 20-period simple moving average. You need to be mindful that if you have a 20-period SMA already loaded on your chart when the Bollinger Band indicator is loaded, the center line of the Bollinger Bands indicator may not appear, as it will be completely covered by the SMA already on the chart. The upper band is plus 2 standard deviations away from the middle line, and the lower band is minus 2 standard deviations away from the middle line. You will notice on the chart that most of the price action is contained within the upper and lower bands, and even when price does cross above or below them, it generally retreats back into the band's confinement relatively quickly. The Bollinger Bands indicator that we can see on the screen now is an example of what the band set at 1.5 standard deviations looks like. You can see that although most of the price action is contained within the bands, when it does make an exit on a sharp move, it doesn't rebound back inside the bands aggressively. Tightening the standard deviation bands to 1.5 is only recommended if you are trading a low volatility market, where price is struggling to reach the bounds of the 2 standard deviation bands. If price is spending too much time outside or near the bands, then they may be too tight. It is important to remember that the Bollinger Bands indicator will be generating signals when price is trading around the extreme zones. So if the bands are too tight, you may end up with a high number of false signals. The chart that we can see on the screen now has the most popular 2 standard deviations set on the Bollinger Bands indicator. As you can see in the example, nearly all of the price action is contained within the bands, and when price does occasionally break through, the retracements back inside are quick and sharp. It is easy to see why this is the most popular setting, and is the one that adapts itself to the widest amount of trading instruments and timeframes without needing further fine-tuning. The chart that we can see on the screen now has the Bollinger Bands indicator set at 2.5 standard deviations. This example shows us that apart from 2 or 3 candles exceeding the boundaries, almost all of the price action remained inside the bands. In fact, price only gets close to touching the bands when the trend changes and moves aggressively in one direction or another. This setting is ideal for very volatile instruments such as exotic currency pairs and some commodities, as otherwise price would simply not get close enough to the bands to make them useful to a trader. However, when this setting is used and price does push the boundaries, you will generally get a very strong correction back in, which makes them good zones to potentially take profit if the market pushes out to the upper bands for a long position and the lower bands for a short position. As I mentioned earlier in this section, the Bollinger Bands indicator measures volatility, and the bands expand and contract as the volatility increases and decreases. You can see this start to happen on the example that we have on the screen now. As price starts to decrease in its range of motion, the upper and lower bands come in and get closer to the middle line. When price starts to move aggressively in a direction, the bands expand accordingly until the volatility decreases and the market settles down. You will notice that even when the market begins to trend in a direction, most of the price action is still contained inside the bands. In an uptrend, the price pushes up to the upper band and retraces down to the center line rather than the lower line, before it moves up again and continues in the trend direction, again pushing the upper band higher. In a downtrend, price pushes the lower band down, and when it does pull back, it is generally to the middle line, where it turns around and begins to push the lower band down again, as it continues in the downtrend's direction. When the market is moving sideways, price bounces from the upper band to the lower band quite consistently, especially when they begin to contract. The rules for trading Bollinger Bands are easy to follow, and are market adaptive due to the inherent nature of how the indicator works. In a sideways market, you can enter long positions when price touches the bottom band, with your take profit set around the upper band. You can then reverse your trade and take a short position aiming for the lower band for a take profit, highlighted in the yellow on the example on the screen. This style can be continued until the market starts to trend in one direction. In an uptrend, you can enter long positions when price retraces back to the middle line after touching the upper line, with your take profit set when price again touches the upper line, highlighted in the green circles on the screen. This method can continue until the uptrend weakens or reverses. In a downtrend, you can enter short positions when price pulls back to the middle line after touching the lower band, and your take profit is set when price again touches the lower band. Once again, this method can be traded until the downtrend weakens or is reversed. Another way that you can trade using the Bollinger Bands indicator is by trading the extreme moves. When price pushes up hard through an upper band, or shorts sharply through a lower band, it generally retraces back into the bands quickly, which provides trading opportunities if you are there and see it happen. As you can see with the example on the screen, price pushed through the upper boundary and didn't close outside the upper boundary. When price comes back inside, you can place a trade in a short direction with a take profit set at the middle or lower line. In the middle of the chart we can see another example of an extreme breakout. You can trade this long when price comes back inside the bands and aim for the middle or upper band as a take profit level. On the right of the chart, we can see another extreme breach of an upper zone, where price quickly retraced back inside the bands. This provided an opportunity to take a short position, with a take profit set at the middle or lower band. I do not recommend that you use this method in markets that are trending, as any trade you reverse out of a price push outside the band in either direction will be trading against a prevailing trend. However, this method works great in sideways markets with low to medium volatility. Earlier in this module, I discussed the concept of divergence. Divergence occurs on the Bollinger Bands indicator in much the same way it does with MACD, and you can apply the same rules on how to trade it, with one notable difference. Because price is usually pushing the bands at peaks, you can incorporate the MACD indicator discussed earlier to identify the signals. This is because by design, price and the Bollinger Bands are not going to deviate away from each other when volatility increases, and the volatility is required for a reasonable market move. With this style of divergence trading, you are using 3 confirmation tools instead of 2. Firstly, you are on the lookout for any divergence between the MACD indicator and the upper bands for bearish divergence, and the MACD indicator and lower bands for bullish divergence. The third filter is price itself. As I discussed earlier, when price is pushing through the upper or lower bands, it generally retraces back inside fairly quickly, as it is an extreme zone. If a situation occurs where there is divergence present between the Bollinger Bands and MACD, if price is pushing outside the band where the divergence is present, it acts as another filter, or evidence of an impending reversal, making the signal even stronger. The example we see on the screen shows a situation where price has made a higher high and the MACD has failed to follow, making a lower high at around the same area. You will recall that this is considered Class A bearish divergence. Notice that the price has pushed through the upper boundary of the Bollinger Band and retraced back inside at the highest peak. In the middle of the chart, price has made a new lower trough, and the MACD has failed to follow, making a higher low at around the same area. This can be labelled Class A bullish divergence, and once again, price has penetrated the lower band at the lowest trough. Notice how explosive the move in the opposite direction is on these 2 trades when the indicators are combined with price volatility, a required ingredient for price to push outside a Bollinger Band. On the right of the chart, price has made an equal peak, and the MACD has failed to follow, making a lower peak at around the same area. This can be labelled Class B bearish divergence. Following this rule highlights the extremes that the MACD and the Bollinger Bands indicators have reached, with the added benefit of higher volatility, with price pushing through and penetrating the upper and lower bands, adding further strength to the divergence signals. In this lesson, we have learned how to interpret the different Bollinger Band deviations. We have learnt the rules for trading the Bollinger Bands indicator. We have learned how to use the Bollinger Bands in extreme moves. And finally, we learned how to interpret and trade Bollinger Band divergence. This concludes section 5 of Trading Indicators. In the next module, we will talk about the psychology and risk management that is required to be a successful trader. We will talk about the important aspects of managing risk and how to apply the correct psychological approach to all of your trading plans.